Welcome to TheoTrade. This is Don Kaufman. It's July 18th, 2025. Few minutes left before the cash close here on this Friday afternoon. The S&P futures are down a staggering 11 points. But on the week, we are once again very close to massively unchanged. Nevertheless, what we are going to discuss in this TheoTrade Weekends Update can only be described as kind of a critical correlation breakdown, which I am going to be showing you here momentarily. Before I get into that, let's just talk about the marketplace as a whole. We're in, again, we're kind of can be described as a little bit of summer trade right now. The volume inside of the S&Ps is not exactly getting it done throughout the course of this week. We're lucky, and I mean lucky, to hit 1 million contracts. And what's unusual is that today, this is a big OpEx, big options expiration today. You know, just in the S&Ps, it's like 2.8 trillion are supposed to come off the books between the AM and PM settlement, but I got to tell you, it's not a lot of price action. This is where I was like, oh, there's people on vacation. Machines don't go on vacation. You know, you just feed the algorithm a little bit of power, and you're off to the races. But it's slow out there, and it's interesting because we're not really reacting to any of the news coming out, like not tariffs, whatever. The threat of possibly firing Jerome Powell earlier in the week that moved markets momentarily. Today we had consumer confidence. We just kind of brushed that one off a little bit. So what's going to move this marketplace? Well, that's exactly what I'm going to discuss over here. But the main theme right now is we're range bound. This is kind of what I would term stuck in the middle with you. Take a look at the S&Ps going back here quite a ways, but let's kind of box them in just a little bit. All right, almost all of your trade has actually occurred in pretty much a 50-point range. There's no question we're at the upper edge of that range, but just take a look, okay? As again, I'll box that in once again for you, just so you can see how tight the range has really been. I mean, literally almost every ounce of trade, okay, for the last few weeks has been inside of 100 points. And as I was saying, most of that trade has actually persisted inside of a 50-point window. So not exactly enthralling out there. At a time like this is where you got to be careful. You don't want to over allocate, because if you do and you're wrong, you get ripped apart. I mean, and that's exactly, you know, markets like this, they get a little slow, kind of feel like, you know, you get roped in a little bit. And you're like, come on, place that position. And it doesn't matter whether you're bullish or bearish, you know, in Nvidia or any of these tech stocks right now, because if the market starts to move, you know, higher, everything's going to move higher with it. If it starts to move lower, okay, you know, you could get absolutely taken apart. And interestingly enough, I was looking at exactly this, and I was looking at this really, really tight range that we're in. And, you know, I kind of deviated a little bit, and I started looking at S&P equal weight versus S&P market cap weighted. And I'm going to explain this. I'm going to spend a few minutes on it because, as I said, like I found this like critical correlation that's kind of breaking down. And I'll start to kind of describe it to you. So we're going to move away for a moment from the S&P futures, and we're actually going to move over to what's called RSP. If you're not familiar with RSP, that's okay. What you're looking at is this is an S&P 500 equal weight ETF, okay? And what that basically should impart upon you is that if the components of the S&P 500, okay, were equally weighted, all right, this would be, you know, obviously the price chart, and you're like, who cares? Because they're not equally weighted, right? They're not. Okay, but that's not why I'm looking at it. So we're going to get there in just a moment. But this is an equal weight, which, you know, the first thing that's kind of striking about looking at it, and again, I'm actually going to pull up like a 3-year, is that in an equal weight scenario, we're not at all-time highs. That's the first thing that kind of grabs your attention about an equal weight, okay? But that's neither here nor there, because everybody can, of course, point and say, like, yeah, of course we're not, but who the hell cares, because I own Microsoft, which is, in Never Never Land, or I own Nvidia, which is literally in Never Never Land here. And that's fine. But I wanted to go a little bit deeper than just on the surface of like this equal weight. So I went in, okay, and we're going to put RSP. So RSP, once again, is an equal weighting in the S&P 500. Then we're going to cruise up here to like studies. We're going to come over here where it says like add study, and we're going to go compare with. We're going to throw a comparison chart in play here. And what I'm going to compare it with is going to be the spiders. Okay, now we're getting somewhere. Let's get crazy, right? So we're comparing an equal weight versus, well, the spiders, which is not equally weighted. It's market capitalization weighted, right? Okay, as I said, now we're getting places. So as soon as you go into a comparison chart, the comparison charts are a little bit weird because it just matters like what data you're comparing, like how much time frame you put in here before you really start comparing. To critical when you're using a comparison chart to use line charts against line charts. So you got to change your style up here, go from like candle charts, drop to a line. Okay, now let's kind of label everything so that everybody's kind of comfortable here, because what we basically have is up top over here, that little monkey's the spider. Down below over here, that's your RSP. So this is equal weight versus, okay, not equal weighted, market cap weighted. We all know the biggest market cap out there, of course, is going to be Nvidia. You got Microsoft, you got Apple. Okay, those are your big market caps. So why am I looking at this? This is a comparison chart. This is not correlation. Start looking over like 3 years, you can see some pretty wild divergences. Okay, and again, I'm looking now at a 3-year daily. It's a 3-year daily, and it's a comparison chart. And what I want you to see, okay, this is your primary, this is the S&P. There's times, okay, where the RSP outperforms the S&P, and then there's times where the S&P outperforms the RSP. Okay, the one thing though that I do want you to see is when they converge. Okay, look at some of the convergences in here. When I say convergences, okay, what does that really entail? Like right back here, there's a big convergence. Like this is a huge outperformance. And all of them slammed back together. And all of a sudden they diverge and then slam back together. What do you see when they converge? Okay. There's only one truth in here, and that's this. And you'll start looking at comparison charts. Okay. When they converge upon one another, it's typically in some heavy volatility. Although that's not always the case. Like right in here, okay, that's not exactly some heavy volatility, but there's definitely some selling going on, here, and some buying going on here. This is probably tech, but again, they slam together, okay, in the midst of volatility. They slam together in the midst of volatility. They slam together in the midst of volatility. Okay, so I wanted to go through that because I think it's, it's a very poignant point to be made in here, and I can even pull up like a 5-year. In the comparison, okay, this is a 5-year weekly. And you can see, again, things kind of slamming together in the midst of volatility, slamming together in the midst of volatility. Okay, even these little blips on the radar screen in the midst of volatility. Now, okay, here's where things start to get actually interesting. So I'm going to snap back. I'm going to come to a 1-year, okay, and I'm going to start to bring up some correlation, because to me, to compare things, okay, that's just like an eyeball test. You're like, look, the S&Ps are outperforming, okay, the non-S&Ps, the equal weight, right? So that's easy enough. The interesting part is when I started to look at correlation here, okay? So we're actually going to pull up a correlation study. Now, I'll explain exactly what a correlation study. So we're going to look at the RSP versus the SPX, okay, on a 10-day kind of like, average out there. So I actually set it, just to the default of 10 days, and I am using SPX because I think SPX is probably the best way to do it. I'm going to hit apply and I'm going to hit OK. But let's get crazy. But let's pull this volume off, because I think the volume is in the way. So hit that little sprocket, come over here to equity, show volume subgraph, hit apply, hit OK. All right, now we're talking. So what we have here is a 1-year chart. And what you're looking at here is a huge breakdown over here of correlation. But even right now, this is a pretty big freaking break of correlation. Okay, what does this entail? Like, what does it take? Most of the time, and I'm going to look at this now on a 3-year basis, most of the time, okay, your equal weight S&P and your market cap weighted S&P have, okay, a 95%, for instance, correlation, which means that they move in relative like tandem. Like most of the time, if this moves like this, okay, then this moves like this, and they're within, 95%, okay? All of a sudden, though, does that stand out to you? Of course it does. It's a standout because there's not that many spots on this screen. It's even bigger than this one. Here's a big one. Here's a really big one. Here's a big one. Okay. Here's another large one. So you got 1, 2, 3, 4. Okay. There's only really 4 other instances of correlation breakdown in the last 3 years. Okay. That are of significance. And what's interesting about these correlation breakdowns right here, this was a big bout of volatility. Okay, it was a bout of volatility. Oh, there's some sell side activity in here, and here happens to be the S&P. As you see, the RSP was actually breaking down quite a bit. Over here, okay, this was just Mr. Toad's wild ride. So we spurted up, and then we actually came down heavily. And again, I'm just displaying to you, all right, some obvious points over here, right in this neighborhood here. This is a really big correlation break. Crap got downright crazy. Okay, and it got really crazy, obviously, coming into April, but there were rumblings of that just before. Okay, the point that I am making is, look, this correlation break could get substantially larger. It's not a timing mechanism right now. Like it's not showing like timing in here because the correlation is starting to break apart. It doesn't say like volatility is imminent, volatility is tomorrow, okay? But there's no question based on the data at hand. And especially like, people go, well, maybe you should go back more than 3 years. To me, though, the data here is probably only really relevant in like the last 3 years because we all know what's causing the correlation breakdown is what used to be called like the Magnificent Seven, which is probably like, it's the Fabulous Four now, or whatever the hell you want to call it. But that's what's actually causing it. That's it, people. It's over. It's all over. Okay. But look at this. The S&P is down a massive 6 handles in here. The point of me taking you through this, though, okay, is again, we have something on, the books over here that is significant. We have this kind of critical correlation break. And as I said to you, it doesn't say we're going to break tomorrow, but I'm going to tell you one thing. This, okay, visually speaking, this, when I say this, right there, that is one of the larger divergences. It's really, really clean. The only way to come out of a divergence like that, when I say a divergence, like one going up, the other one kind of going up, the only way to come out of a divergence is for these two, okay, to basically converge upon one another. There's 2 ways to actually converge. Okay, how do you converge? Well, the lower product can ripping up, okay, or the upper product can come ripping back down. Right now, just given the market cap weighting, it's so substantial of a handful of products. Okay, in my estimation, the only way you can actually converge in here is to see some of the magnificent, stocks kind of break down. As I said, this is not a timing mechanism. It's not a timing mechanism. But at this point, okay, I assume because of this correlation kind of breakdown, you're on the clock. Effectively, what we're saying is it's about to be some volatility, and it's going to start to pick up. What's interesting, and the most interesting thing is, I don't really see anybody reaching to buy volatility. I would have expected that trade would kind of pick up on this and be like, all right, let's start hedging, maybe a little bit here in the VVIX, but nothing really to speak of. There's definitely some hedging activity as akin to the, if you look in specifically to the skew, like skew is really elevated again back in the 150 range. I mean, we've seen higher. So it's pretty obvious what's actually causing, the correlation to actually break down. It is your Metas, okay? It is your Googles. It is your Microsofts. Of course, it's Nvidia and a little like side order of Broadcom out there. Nevertheless, okay, that's not the point. The marketplace right now is just simply saying that this has become significant. That is the critical correlation kind of breakdown. All right. Let's switch gears entirely over here. Spend a lot of time on that, but it's something that, again, we're going to be watching. And I bet you anything, you bring this up in a couple of weeks from now, all of a sudden they're going to converge upon one another. We're like, you told you so. Okay, but that critical correlation is something you guys are well worth the time to put in to set your charts up and take a look specifically at that. All right. Let's cruise back over to the SPX for just a moment. I do want to bring up the fact that as the market just closed a moment ago, where did we actually close in the week? Mildly higher. I mean, net, when you start looking even at an intraday chart, the week started at 62.60, okay, closed at 62, basically 96. So what do you got? 36 point some odd move to the upside. Look, for me, this is massively unchanged. I mean, you're expecting like a $90 move. Actual move, $30. Okay. Here's the really crazy thing about this. Okay. The move that we saw this week, we didn't hit expected move last week, and we didn't hit expected move this week. Again, I'll bring that back up in just a moment. I just wanted to cover it as the market had literally just closed. The other thing that's still, really on my mind and continues to be on my mind, bonds. This is still like, trigger happy area over here. All right, so the bonds kind of mellowed out a little bit. There was some heavy sell side activity early in the week. Okay, continuation from last week. And then the last, Wednesday, Thursday, Friday, things just like, everybody just calm down. We kind of mellowed out. But the bonds are still like a really at risk. This is like on deck, if you will, to see a break. You come down to 110, you get to 109. It's on at that point. Like markets could actually freak out. So that's something we're obviously going to be watching into early next week. And, obviously, again, everybody's got their thing about earnings, okay? Yes, some of the big tech stocks are going to start to go through earnings next week. But again, I don't think that takes center stage. I think what constantly takes center stage is still going to be, the Trump effect, macro, data and so forth coming out. The markets, though, this week didn't really pay attention to very much. Speaking of earnings, okay, earnings flips. We did extremely well this week. In earnings flips, I hit trades in American Express for 118%. You guys are welcome to take a look at any one of these trades too. So an AXP, okay, open and closed, open for 62 cents, closed for $1.35. Obviously, 3M, okay, here's another one I hit. Open for 77 cents, closed for $1.65. Then Taiwan Semiconductor, okay, TSM. This was a 146% return, open 54 cents, closed, okay, for a $1.33. Winner chicken dinner. I actually put on 6 trades, total of 6 trades. 3, okay, expired worthless. But who cares? Because the other 3, 118%, 114%, and 146% respectively. That, people, is how you get it done with earnings flips. All right. Last, but definitely not least, as we always do, we look at the SPX. We look at expected move. Again, I was just bringing this up a moment ago because the market's just closed. But as I was saying, okay, it is highly unusual to see 2 consecutive weeks we did not hit the upper or lower edge of an expected move in 2 consecutive weeks. So, hey, this is, what do you think about this at this point? Like, let's get ready to rumble, okay? But it's still effectively summer trade. You look a week out, what do you got? The expected move dropping substantially to $75. Look, we're just coming out of a week. We had a $90 expected move. And I want to make this very, very clear, okay? We had this $90 expected move, okay, in this week of trade. The previous week was just mildly higher than that. Next week's move, okay, actually diminishes all the way down to about $75. Now, it's not set in stone yet because, again, the SPX is not closed, but we're actually kind of zeroing in somewhere about a $75 move. Here's another time where, again, got to reiterate this. I'd take the over. Got to be careful, okay? When volatility gets down, like you're starting to look out, all the way, when I say all the way out, all the way to like July 25th, a week out, and the vol is like 10.8%, okay? Let that resonate with you. Do not sell the short dated options. Do not sell short dated options. And I am well aware everybody in the world out there with a YouTube channel is talking about making a fortune selling zero DTE. Are you out of your mind? You don't sell 10%. Okay. There's nowhere for volatility to go but higher. Do you know what's really crazy about this? The Monday volatility. Okay. There's definitely somebody that's like listening to this and they're like, oh man, I sold the Monday volatility. Congratulations. You just sold a 6.77 vol. Okay. That is lunacy. Okay. I hate to end a video like, on like a sour note, calling somebody like, absolutely nuts. Okay. But you don't sell 6.77 vol on the retail side, because at that point, well, what is the point? Okay, you basically, congratulations, you sold some of the lowest volatility ever recorded inside of the SPX. Congratulations! They should actually hand you a award. That is not, okay, what you want to do. This next week of trade, no matter what, you want to be on the buy side of that volatility, especially in the short dated options. People, this is going to get interesting. You got, again, what I call a critical correlation breakdown. You got bonds that are on the dance floor to actually break lower. Okay. Nobody's looking for risk to break out. And that's exactly when risk breaks out. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.